The Reserve Bank of India is putting its might behind the government to keep the borrowing cost low for centre as well as the states. This support from the central bank is coming despite higher inflationary pressure. RBI is defending its decision by explaining that the G-Sec yield curve management or low borrowing cost for the government is for the public good. It says the yield management not only brings down the government borrowing cost but also reduces the interest cost for the corporate sector in the bond market. But as they say, there are no free lunches. There is a cost of keeping the interest rate low. So who will pay this cost? What are the dangers of adopting such a policy of low interest rate and yield management when the inflation trajectory is highly uncertain because of COVID outbreak and ultra loose monetary policy? Let's dive deeper into the likely consequences of low interest rate policy. The risk of high inflation is the biggest cost of keeping the interest rate low when the prices of food, fuel and other household items are rising. RBI's own forecast for retail inflation is at 5% in the current financial year, which is close to its upper tolerance limit of 6% mandated by the Parliament. Despite these higher numbers, the RBI has committed of keeping the interest rate low to support the economic growth and also keep the borrowing costs low. The low interest rate will also encourage people to spend rather than save. Savers are already getting negative real interest rate today. State Bank of India's annual interest rate for retail term deposit is 4.4%, whereas the RBI's inflation estimate is 5% for the year. The depositor, who also pays taxes on the interest component, end up earning in negative as he or she is also a consumer who is impacted by the inflation. To put it more simply, you are earning Rs 4,400 as interest on a term deposit of Rs 1 lakh, and as a consumer with 5% retail inflation, you end up spending Rs 5,000 more because of inflation in food, fuel, education fees and other items. The postal saving rates are also linked to G-Sec yield, and if the yield is managed or put at a lower level for an extended period, the retired people will suffer by getting negative returns. The low interest rate policy will also lead to higher risk taking by banks, institutions and also retail borrowers. The easy money with low borrowing cost will also find its way into stock market, commodities and real estate. Depositor faced with low earning generally shift to speculative areas without understanding the risk. These imbalances could create bubbles in the financial market and also trap the gullible depositors and the savers. Globally, we have seen negative interest rate across US, Europe and Japan when the central bank's lending rate was near zero level and the borrowing rate were negative. This meant banks earned negative rates or actually paid the central bank for keeping their money. In India, we have not reached at that stage as the RBI's short-term lending rate or the repo rate is 4% and the rate at which the RBI absorbed excess liquidity from banks or the reverse repo rate is at 3.35%. But the repo rate and the reverse repo rate corridor has been reduced from 25 basis point during normal times to 65 basis point, meaning RBI is sucking out excess liquidity at a much lower rate from banks or discouraging banks to park their funds with it. An extended period of low interest rate to fuel economic growth or support government's borrowing is not a fully tested formula for fueling investment, protecting growth and avoiding high inflation. The negative rates in US, Europe and Japan have not resulted in high investment or high economic growth in the last decade. The logic that the low interest rate will reduce the cost of capital for the industry is also debatable. In a country like India, only the AAA-rated corporate gets the benefit of low interest rate. A large number of lower rated companies, especially MSME, end up paying a much higher interest rate. Similarly, a large population in the unorganized sector deals with NBFCs, MFI and local money lender and end up paying a much higher rate than what the bank charges from a salaried class. The low interest rate also put a downward pressure on banks' profitability as they charge extremely low interest rate in certain loans. Under the extended periods of low interest rate, the players like insurance companies, pension fund, which largely invest in fixed income security, also get impacted. The low interest rate is also impacting the rupee value against the US dollar. The foreign investors know very well that the RBI has no option but to keep the interest rate low to help the government in borrowing from the market. These investors may go to other emerging markets where the interest rates are hardening and reflect the true picture. Currency depreciation will also discourage dollar inflows into the Indian stock market. It will also fuel imported inflation via crude oil and other commodities. What should you do to protect your savings? Gold is always a long-term hedge against inflation. One can diversify their investment in gold, though for the government this will mean higher gold import and also a pressure on the current account deficit. If you are keen to invest in the stock market, go for high dividend yield stocks with a proven track record of performance. In such stocks, you will also have the advantage of capital appreciation if the price goes up. Keep your fund in short-term deposit and other instruments, because if the interest rate goes up tomorrow, you can easily switch. Clearly, low interest rate is not a solution or a remedy for managing a difficult economic situation. You also have to play around with the fiscal and other tools to pump up the economy. Even as small savers and depositors try to chase assets with higher return and also with higher risk, there is a much higher responsibility on the shoulders of the government and the regulators to protect their savings and also safeguard the economy.